open in Asia this morning. Prices up 1% after a cyber attack forces the closure of one of the main distribution pipelines for gasoline on the eastern side of the United States. Let's kick off this morning with Omar Najia. Good morning, Omar, Global Head of Derivatives at BB Energy, sitting in Dubai. Whoops, some noise echo there. Sorry, if anybody has that, maybe we can mute that background noise. But Omar, prices last week did it up and down, tried to get over 70 on Brent, never got there despite major draw on US stocks, and now this noise of a pipeline disruption. Is there anything that'll get prices above 70 on Brent?
Yeah, I think basically the market is headed that way. It's been headed that way for a while. So markets, they don't just move in like straight lines. They don't go from like 60 to 70 and then 70 to 75. And so basically they go up. It's like, whatever, 2 steps forward, 1 step back, or 3 steps forward, 1 step back. So market basically set a high on WTI around $68. It then came off from about $68 down to about whatever that level was, about 57 actually, and then moved from 57 back to the upside. So yes, I think basically prices will get over $70 on Brent. The reasons are many, to do with economic recovery across the world. You've seen it in China, it's coming to the West. The pipeline thing is interesting, but again, I don't think it's the impetus I mean, stuff like this happens regularly, whether it's a tanker blowing up or a pipeline going offline, and that'll come back online. And when it comes back online, doesn't mean that prices are going to drop and that kind of stuff. I think directionally trending, the market is trending to the upside. And yes, it's going to take out $70, but it's not going to do it in a straight line. But I think, you're going to see the market rise robustly from here going forwards into the summer, into the end of the year.
Sarah Akbar, Chairperson and CEO of Oilserve Kuwait and Non-Executive Director of Petrofac. Sarah, I think one of the most notable elements, I think, at least thus far, with the pipeline disruption in the US is how vulnerable the infrastructure is. We've seen in recent weeks the closure of the Suez Canal, major choke point on global trade, now pipeline vulnerability in the US. This, I suspect, from your perspective, is how unique, how vulnerable is global energy infrastructure? I think you're on mute, Sarah. There you go.
Good morning. And yes, cyber attacks, this new virtual world where we continuously promote and drive towards a complete AI data-based kind of operations for all our ports, our pipelines, facilities. And so they are so connected throughout the system, which makes it very efficient, but in the same time makes it vulnerable. And so cyber attacks on oil installation and facilities is not new. Actually, I have seen several cyber attacks that brought down operations in companies to a level where you spend something like $40–50 million in a year just to recover what you lost because of those cyber attacks. And there are a variety of cyber attacks. Some of them are for ransom, so they take your data, they shut down your system, and then...
Which seems to be the case in this example in the US.
But there are 4 different types. But the worst type is when it is really related to damage. So people just want to damage the installation. It happened 3 years ago. There was a series of attacks on several companies in the region. It was driven by, a country that wanted to stop operations because they were subject to sanctions. So things like that are very traditional, I mean, it happens now very frequently in our industry. It is massive because it can.
Given how vulnerable the infrastructure is, and obviously we're moving every day of the week more and deeper into a digital world, are companies, obviously you're sitting in an oil services space, you have for being many years in the region as an industry leader, are the national energy companies spending the required amount on this cyber defense that is clearly very necessary at this time?
Absolutely, absolutely. It's always on the top of the priority, and they will, they spend to the last dollar in order to protect the operations. However, these hackers, these systems get smarter and smarter by the day, and you just have to keep up. So this business is becoming a true big business, cyber attacks, and there is a lot of money being spent on both sides of this. So, but after the attacks we had 2, 3 years ago, I think all the national oil companies, all the service providers, they spend the big dollars in order to secure the operations and have backups, and being able to operate manually and being to operate off the system. So yes, all of those contingencies are in place in order to make sure that you can continue operating and not being affected.
Ed Bell, Senior Director, Market Economics at Emirates MBD. We saw at the end of last week, Ed, sort of the driver in the oil markets was from the the latest unemployment report out of the US, which showed a much lower number of new jobs than expected. And that took away the threat that the Fed might have to act on inflation. And so the markets like that and they rose. What was your takeaway? I was just reading this morning the Emirates MBD note, and clearly that was the top of your item.
Yeah, I think what was so significant about it was how considerable the miss in terms of the data print versus expectations. So it came in at 266,000 jobs added for April, but the market was looking for something on the order of 1 million. So quite a considerable gap there. And I think there's a few things to unpick in terms of the nature of what's happening in the recovery. So we actually saw some sectors related to sort of temporary work hiring lose ground, warehouse staff losing ground, as a lot more people have already come back in to employment in a more sustainable or on a more permanent basis. I think what's pretty crucial though, and it seems a little bit hack of a way to get out of this, is that 1 month on its own does not make a trend. So we'll be watching quite closely, given that we are still coming out of a highly compressed business cycle where we're going from quite decent growth at the start of 2020 to a very sharp contraction. Then we had a very strong recovery at the start of 2021 in the United States. So trying to pin too much on a single data point, I think, is a little bit probably irresponsible or reckless.
But you did include in your note this morning that obviously it was the last report was a slowdown from the previous month in March, but it itself in March had to be revised down from 916,000 jobs to 770. So it's not a complete outlier.
Yeah, but still job growth of over almost 750,000 would have been still very strong that we had in the month prior. I think we had always been a little bit, I wouldn't want to say bearish, but maybe expecting to see a recovery at a lower trajectory. So we were not expecting to see that the Fed was going to be responding to concerns about inflation or talking about asset purchases being cut back at any point in 2021. And I think this really kind of affirms the Fed's patient, steady as it goes kind of mentality to wait to see that the US really gets back to full employment on a more sustained basis. And when you look into some more of the granularity of the data, it's not just those kind of headline numbers like the NFP on a month-on-month basis or the headline unemployment, but looking into things that the Fed is targeting like female unemployment and employment of different demographics in the United States, all of which don't have a sustained trend towards improvement just yet.
Omar, just coming back to your point on nothing moves in a straight line, and clearly that is true, but ultimately we have been sort of stuck in the 60s range for a while. We've had some major breakthroughs, the forecasted growth, the obviously events that come and go, India, and this week now with the pipeline. The price seems to be that momentum that was moving is certainly stalled. The longer it gets stalled, does it risk actually derailing, reversing? What's your own sense? You've said in the past that this might be a slow next step. Where do you see momentum being key in the market?
Again, you have to look at the market chronologically, right? So you had a move from, let's say, zero up to about $68 on WTI, right? So it's always good to take like a break or a breather or consolidate. What consolidation does is it builds support below the market. It's never good to see something go from 0 to 100 because there's nothing below to support it when it does want to correct or come down. So the market went up. Momentum was amazing. Everybody was saying, won't get to 53 because shale. And then it was like, won't get to 63 because shale and Iran. And now that we're at, 66, we're going to get to 70 on TI and 70 on Brent. And we're still going to be looking for shale to come back and Iran to come back and all the rest of it. So what I'm suggesting is that those are not the drivers that are driving the oil market higher. What's happening now is the market is consolidating, but I think very shortly it will want to break out to the upside. So you get momentum that goes up.
Why would it break up to the upside when there's no shortage of supply, despite this pipeline incident, which is obviously gasoline, the East Coast of America, and I'm sure it'll have a pop on gasoline prices. But where does the momentum come from for higher prices when there is a significant amount of supply available, i.e. there's no shortage anywhere?
Well, I don't get that. There's no shortage anywhere in terms of what? In terms of OPEC capacity? No, that's incorrect. So yes, OPEC has spare capacity and could put on the market another whatever it is. But what people always tend to forget is, just like in equities, this is a managed market, right? So it doesn't matter what OPEC has in terms of spare capacity. It's like saying, yeah, you know what, the S&P can go up, but really it's not going to go up if the Fed isn't there to support it with liquidity and printing money. But yeah, of course. So yes, if you want the oil market to fall, OPEC will have to put all their production on the market. Will they do it?
It's not necessarily a fall. It's about what is the momentum to go higher. The market does seem to be reluctant to go higher based on whatever factors. That it's one thing that's not necessarily to go down, to crash, but ultimately to break out of the current range bound.
Yeah, so basically
flying. What takes us above 70?
No, it's not. By the time price gets above 70, you might see people flying afterwards, but it's not like, so it's not basically look for something and then point to it and then everything goes up. It's the market has sentiment. The market looks at technicals. The market is trying to make money. It really doesn't give a damn if people are flying or people are dying or people are hacking. It's got nothing to do with it. Markets will move on sentiment and the ability to make money. If you want to make money and you're there and you put your money and you're bullish and the market goes in your way, your favor, for whichever reason it is, whether it be money flow, whether it be whatever. So you get a lot of times in this market where you see basically people come and tell you, yeah, fundamentally this market is bearish. So they'll put like $1 million on a bet that markets will go down. And then you have money flow. People who've got nothing to do with the oil market, they've got not $1 million, but $10 billion in their pocket, and they will bet it because they feel like the market's going up, they have sentiments, technicals, whatever, they'll bet it. So you can be as fundamental as you like, and you will get absolutely steamrolled. And it's got nothing to do with people flying or hacking or anything to do with that. It's about the flow of money sentiment. It's about other markets, exogenous markets. What are they doing? What's Bitcoin doing? What's the S&P doing? What's the feeling? Are people bullish? Is it risk on? Is it risk averse? What's the dollar doing? But the least it's got to do with is basically people flying, the least, or hacking.
Flying or hacking, or perhaps both. Sarah, meanwhile, back at the ranch, we're seeing ADNOC announce overnight looking for banks to pitch to book run the sale of its ADNOC drilling. Of course, that's a space where you're operating within the oil services space. What do you make of this story, this development, and what kind of a trend are we on here as we see national energy companies in the Gulf offload assets bit by bit?
So, over the last couple of years, I mean, since 2016, ADNOC and the UAE has been in this process of creating efficiency in their systems, and in the same time, creating a whole suite of companies that they can float in the market. So their attachment to the oil and gas business is smaller as government. So they still have a big chunk invested in these companies. However, they have a whole suite of partners in all facets of the industry and at the same time, they bring in some more money from the sale of these assets. I think this trend will continue in the region because Saudi Aramco is basically thinking to do the same thing. I think sooner or later, the rest will follow because this is actually the best way to operate. It will create the best efficiency for these entities. By now, we all know governments managing service companies or even oil and gas companies is really not a good idea. They are better off leaving it to the professional companies, the IOCs, the NOCs, to do it without subsidies, without interfering in their business. And this is the first step towards that kind of environment where it is a true free market for all, where you have national oil companies as holding companies, but underneath they have a whole suite of partnerships, JVs, private, publicly listed companies that they have shares in. I think if you look at this, the best model of this is actually the Norwegian model, because in Norway, they did this when they sold a big chunk of Statoil into the market, and then they created this new entity where they have shares in many concessions, but as government themselves, they really are not in the business. I think that's the model the region will be following, I think, in the next 10 years in order to slowly detach themselves from the oil and gas business the way they are heavily reliant on now, and inviting the private sector to participate in these ventures, because that will bring transparency, efficiency, public, and create a real oil and gas market. As you know, in this region, none of the stock exchanges have any shades of money that comes from the oil and gas, and that's something that has to change over time.
Ed, just coming back to the theme of the discussion this morning, this year of disruptions, shortages, we're seeing obviously the Suez Canal incident, the pipeline incident recently, shortages across lumber and even labor now in terms of the availability. They say in the US, the availability of labor, people becoming enjoying their subsidy and welfare, but shortages also on shipping labor, seafarers. So disruptions, shortages, bottlenecks seem to be a characteristic of this post-COVID or coming out of COVID. I just welcome your assessment on that and what could be its impact on the economic recovery this year.
Yeah, I think one thing that we see pretty much across any geography, US, UK, across the big economies in the Eurozone, and increasingly here in the GCC, on very short-term economic measures, is that the cost of doing business is increasing for a lot of the points that you're bringing out there. A shortage of materials, higher feed-in costs from, particularly for here in the UAE, shipping goods, or here in the GCC, shipping goods around the world. And so that's going to lead some of that is being passed on in economies where there is strong enough consumer demand that can be supported. So we're seeing that being passed through in the United States, not quite to the same degree here in the UAE, where I think we're still at a tentative stage of economic recovery. But the interesting thing to note is when you look at all of these kind of input costs are at their highest levels since 2008 or 2009. Input or output costs are at their highest level on all these metrics since 2008, 2009. This is a very normal part of an economic recovery cycle. So yes, we have a disruption because we had to supplies at the moment because we had a massive disruption to consumption last year. So companies cut staff, they cut investment, supply chains are squeezed, but there is going to be a reaction. You know, there will be a matter of pricing in terms of, let's say, the labor market that needs to be adjusted to get those people back into, say, getting more staff on to work at a restaurant or in a services sector employment. That's going to happen over the coming months. Some of the issues, though, are probably a bit more long lasting. So these issues around constraints around microprocessor supply, which seems to be feeding into basically every industry, could add a more sustained inflationary push over the next couple of months. But that being said, we are still not in the camp where we're really concerned about any kind of inflation. We're not going to go from 1%. And I think the market really is anxious about what happened in the United States and that inflation is going to happen and it's going to be the end. That doesn't mean that we go from 1% inflation to Weimar Germany levels of inflation in the United States. That's really not.
But when you take the shortage issue, right? We had Chris Wood on last week talking about he couldn't buy his bicycle, right? We had Christoph Ruhl in Germany. He couldn't get wood to refurbish his kitchen. So he can't spend his money. They can't spend their money, right? If you can't spend your money, you're not making economic activity. And so my question ultimately is the accumulated consequence of all of that impact on economic growth. This 6.5% economic growth in the US, 10% in China, whatever percent everywhere else. If we have all these shortages, are they at risk in any way?
Well, look, I think it's specific shortages by sector. It's not going to be one that I think we can be concerned about that pervades across everything and is the trend for the way this economic recovery happens. As I said, yeah, you have these idiosyncratic issues around microprocessors, lumbers. You know, there's a limit on how many trees you can get out and being processed through mills and being sent out to homes, as basically everyone went out and tried to buy a home with cheap loans last year. But I don't think that it's a question that we really derail the economic growth story. And remember, we're in a phase where economic policy-wise, government intervention, government support is very much being given the green card by markets. You know, in fact, the kind of stimulus plan that the Biden administration has talked about, $2.25 trillion. I mean, I've been reading quite a bit of reports saying that that's actually quite not enough to see the U.S. economy power ahead over the next 10 years or so. So there is certainly an environment where governments being able to spend to try and get around those supply chain issues is going to be very welcomed by markets.
Let's go to the survey questions, just trying to set it up with that question to Ed. With more and more disruptions, bottlenecks, and shortages as we come out of COVID-19, will that be bullish or bearish for oil prices through 2021? We see, of course, overnight the short-term bullish impact of an oil pipeline shutting down in the US. But what are the long-term consequences of these disruptions and these bottlenecks? You know, the fact that we may have lots of pent-up demand, but do we have the capacity to service that demand and reach these economic target numbers? So will all of these bottlenecks, the shortages, be bullish or bearish for oil prices through 2021? Welcome the view in the room on that point.
Shane, if I may say,
please, Sarah, yes.
You know, two things. First one is, one of the things we see in this region, which will impact us really, is all countries almost closed all their flights from India. And most of the labor work that we have here comes from India. So now we have huge shortages of labor to execute our work. And this will do two things. Either we can't completely do the things that we need to do, and it will create this inflation. And we already see this. We cannot get labor in order to execute the work, the jobs we have to do. Many contractors in Kuwait are declaring force majeure because we can't get labor. So this is truly something that is happening that will have an impact. I really don't know when will India come out of this pandemic, because the way it looks, it is still going up, it is not coming down. And the longer this takes, the more effect it will have on this region. So this is something we need to look at.
Interesting. Omar, just get your sort of weekly insights on all things with the Iran talks. Generally, they're still progressing positively, certainly noisily, but the fourth round of talks ongoing the week, and the positives. Do we have a breakthrough there? Does the market absorb that without too much trouble?
Yes. Absolutely. So, I mean, we've been having these weekly podcasts for a long time, right? If I could have like $1 for every time I heard shale's coming back, or Iran is becoming, more positive, and supply and OPEC cohesion and OPEC surprises and OPEC pluses and all the rest of it. And it all boils down to a very, very, very kind of simple thing. Everybody, it has basically an interest. OPEC is in this to make money, as much money as they can, and that's it. So they're not going to shoot themselves in the foot. They're not going to dive off a cliff. I mean, that's human nature, right? So if we expect that of everybody else, why do you expect something different from OPEC Plus? Same to do with Iran.
Because for many decades, they have violated every agreement that they have put on the table. So it's not.
But this time, no, this time is different.
Clearly,
all the other times, basically, they were making so much money that they shot themselves in the foot. They began to believe their own hype. This is the case where basically their necks are on the line and then their countries are on the line. So believe me, they will have focused minds. Same with Iran. Iran wants to make a deal. The US wants to make a deal, but it'll only happen on Iran's terms. Why? Because Iran has been duped, fooled, cheated before. It's very simple. You do the same thing. Put yourself in Iran's place. You do exactly the same thing. You'd want cast iron guarantees, not a signature and nice words like they had before, when a president basically turns around and says, oopsie, sorry, I'm not going to do this. So no to an Iran deal. Unless it's completely on Iran's terms, which I think Biden and his administration are going to find very, very difficult to do. So in the kind of big picture, I think basically demand is coming back, vaccines are here. You can talk as much as you like about variants and look at Brazil, and no, don't look at Brazil now, look at India and look at whatever it is. The trajectory, the trend is for improvement. If people want to bury their heads in the sand and think, let's be careful now because we could have another variant or something could happen. Yes, everything could happen, but more likely than not, probability-wise, things are going to improve. Simply put, you can either be basically bullish or bearish, glass half full, glass half empty. We've been glass half full for a very long time and the market's gone our way. I would encourage everybody to be glass half full.
We won't be talking up our own book on this show, please. Nonetheless, oil prices were $65 before anybody heard of COVID. So one has to think of all the odds. Ed, your just comment on that Iran piece that seems over the weekend, the big story on Bloomberg, nonetheless, is the point around banking. Iran wants access back for their banks. How important is that for them to function, obviously?
Yeah, I think there was a very good line in that article, actually, where they talked about the residue of sanctions affecting Iran's integration with the US economy. Because as we had during the initial terms of the JCPOA, anybody could do, well, more or less anybody could do business with Iran, but nobody wanted to because they didn't want to have the risk that they could get slapped with some kind of sanctions decided by the United States unilaterally in one way or another. So I think that is going to be a risk going forward, holding back investor appetite, company appetite towards doing business in Iran going forward on a long-term basis. Even before we had the nuclear-related sanctions, I think Iran was kind of a tough place to do business that has all the kind of characteristics and hallmarks of emerging market regimes. So, a very interventionist government, not a lot of ability to capital in and out, and a hugely volatile currency. So even if you had all the sanctions removed at this point, Iran was able to export crude. I don't think the country is in an economic healthy enough place that you'd see a huge amount of investors wanting to be coming back in. And would that make the Iranians sort of feel that they're not getting the full benefit of any deal that they signed and sort of walk away from it again? It's a bit of a rock and a hard place, I think, for the Iranians at this point.
Let's get the survey result and give Sarah the last word. Bullish, will that be bullish or bearish for oil prices through 21? Big number on bullish. Sarah, your thoughts just closing out on the Iranians question. We seem to be getting closer and closer to a rapprochement deal. How does that get accepted in the region? Is there generally a consensus of support, do you think, across the GCC for this agreement? You're on mute, Sarah. Sorry, you're on mute. Yep.
As you saw last week when, the Prince Mohammed bin Salman came out talking about talks with Iran, neighboring, the sentiment is completely changed in the region. And it is truly led by Saudi and by the UAE. And I believe now they are more in acceptance of a deal with Iran, and they will push for it as well because they want to see the stability in the region. So my opinion that even though Iran showing some stubbornness, but eventually this deal will be signed because they will all see their own interest in it. Iran is so keen to go back to the markets and to open up and be, all these sanctions to go away. So I think they will sign this deal, and the GCC in general, they will support, this kind of deal going forward. So I'm very optimistic about this.
Wonderful. Well, Sarah, thank you so much for your insights, and Omar in Dubai, and Ed, of course. We got a Gulf panel this morning, so thank you guys all very much. We are closing out the session with WTI trading at 65.43 and Brent at 68.89, both up just shy of 1%. Best of luck to everybody this week, and happy Eid Mubarak to everyone. We will be back on air tomorrow, and then we'll be off Wednesday and Thursday for the Eid break. But for everybody who's going on Eid today, best wishes and sentiment for the holidays to you and your families. Thank you very much. Have a good day.